Welcome back, Focus Learners. Seriously, I am so thrilled to have you with us today. Because in this explainer, we are going to decode what I can only describe as a massive financial optical illusion in our modern economy. Right now, if you look at the macro data, corporate earnings are strong, unemployment is stable, and on paper, the economy looks absolutely fine. But if you look out your window, it feels terrible for millions of people. So today, we're going to break down exactly what is happening right under the surface.
Real quick, before we jump in, just a brief disclaimer. This explainer provides structural economic analysis for educational purposes only. It is not individualized financial or investment advice because obviously everyone's economic conditions and circumstances vary wildly.
Okay, let's dive right into this central paradox. How is it mathematically possible for the stock market to hit multiple record highs in 2025 and 2026, while at the exact same time, a staggering 55% of Americans say their financial situation is getting worse? And look, this isn't just a tiny blip. We're talking about the fifth consecutive year that a larger share of Americans feel their finances are worsening rather than improving. We literally haven't seen a streak like that since the Great Recession. People's outlook for 2026 is historically poor. 62% are worried about retirement, and 60% are terrified of medical costs. So how can both of these realities coexist?
Well, the answer is the K-shaped economy. Once you understand this letter, pretty much everything about our current financial landscape just clicks into place. Picture the actual letter K. That vertical line? That represents the pandemic, the massive economic shock of 2020. Extending from that line are two distinct trajectories happening simultaneously in the very same country. The upper arm shoots upwards, right? That represents higher income households and asset owners who are actively thriving and growing their wealth. But then, the lower arm points straight down, representing lower income households and service workers who are struggling or declining. It is quite literally a two-speed economy.
So here is our agenda for today. 1. The core disconnect. 2. The four driving forces. 3. The upper arm. 4. The lower arm. And 5. Actionable strategies.
Let's start with Section 1, the four driving forces. What is causing the permanent split?
Force number 1 is asset concentration. Just look at the reality of the stock market right now. The wealthiest 10% of Americans own roughly 93% of all stocks. That leaves just 7% for literally everyone else. What this means structurally is that half the country owns zero or minimal stocks. So think about it, when the S&P 500 jumps 25% in a year, it provides absolutely zero benefit to the net worth of 50% of Americans. The wealth generated by capital is just heavily concentrated at the very top.
Force number 2 is how inflation operates. Inflation isn't this even blanket that falls over everything. It's a laser beam, and it's targeted directly at necessities. Over the last few years, the categories that completely dominate the budgets of lower middle-income households, food, rent, energy, healthcare, have just skyrocketed. In fact, 13% of Americans now cite energy costs as their top financial concern. That's the highest it's been since 2008. Healthcare follows right behind at 8%. So while luxury goods or, say, travel haven't risen as drastically in percentage terms, the basic costs of just surviving are disproportionately draining the budgets of those on the lower arm.
Then we have force number 3. The reality of high interest rates. When rates are high, they act as this massive double-edged sword. If you're on the upper arm with cash, great, you're earning a comfortable 4 to 5% yield in a high-yield savings account. But if you're on the lower arm, you are facing this crushing number, 21%. That is the average APR suffocating anyone carrying credit card debt right now. Add in 6.3% mortgage rates and 7 to 8% auto loan rates, and you see the pattern plain as day. High rates actively help people with assets, and they actively devastate people with debt.
And force number 4 is artificial intelligence. The companies deploying AI are creating literally trillions of dollars in wealth, which of course flows directly to their shareholders and executives. But on the flip side, we are seeing the workers whose jobs are being displaced or who are facing intense downward wage pressure, think customer service, data entry, logistics. For them, AI isn't some magical wealth generator. It is a direct threat to their livelihood, actively pushing them further down the lower arm of the K.
Section 2, the contrast arc. Who is going up and who is going down?
The crucial point here is looking at who is truly thriving. Stock market investors are obviously accumulating wealth without lifting a finger. High-income professionals in growing sectors, tech, finance, AI, are seeing their wages easily outpace inflation. And business owners with pricing power are expanding their profit margins. But I really want you to look at that second point, homeowners with pre-2022 fixed mortgages. If you manage to lock in a 3% mortgage before 2022, your housing costs are completely flat while your asset continues to appreciate in value. Think of it as the golden handcuff of a 3% rate lock-in. It's basically this exclusive VIP club for older homeowners, creating a massive structural advantage that new buyers just cannot match today.
Now let's look at the stark reality of the lower arm. Americans describing their financial situation as struggling or in crisis jumped from 22% in 2021 to 34% in 2026. That is a 55% increase in just 5 years, which represents about 88 million adults. And this isn't just some abstract data point, this is your neighbors, your coworkers, and honestly, potentially you. This pain is really concentrated too. Struggling rates jumped for women from 26 to 42%, and for lower-income households, it went from 39 all the way to 53%.
So who exactly makes up this lower arm? Well, it's renters who have been facing relentless 40% plus lease hikes since 2020, with absolutely no equity to show for it. It's the roughly 40% of Americans who own zero investment assets whatsoever. It's service workers seeing their hours slashed as lower-income customers stay home. And notably, it is Gen Z and younger millennials. For singles in these generations, the struggling rate is a massive 45%. I mean, they are battling historic home prices, resumed student loan payments, and those 21% credit card rates all at the exact same time. They are sitting at the absolute sharpest point of the downward arm.
So you might be wondering, is this just a phase? Chief economist Mark Zandi at Moody's Analytics puts it pretty bluntly. This is not a cyclical or temporary phenomenon. This is a structural, fundamental issue. Inequality is currently at a 60-year peak. We have to look at this impartially. Sure, policy interventions like student debt relief, affordable housing initiatives, or minimum wage hikes could certainly help specific segments, but those fixes aren't fast, and they're definitely not politically guaranteed. Economists largely view this K-shape not as some passing fad, but as a persistent, structural reality of the world's largest economy.
Section 3. Shifting your position. Concrete steps to move to the upper arm.
Because we need to account for the world as it actually is, not as we wish it were, think of this progression as your personal strategic playbook. It's all about playing both defense and offense. On defense, lock in housing costs if the math makes sense for you. Try to convert a variable expense into a fixed one to hedge against inflation. Then, ruthlessly attack that high-interest debt. That 21% credit card debt is compounding against you every single day. Eliminating it is literally the mathematical equivalent of earning a guaranteed 21% return. Then, on offense, build your income. Negotiate a raise, learn new AI-augmented skills, and direct that new money strictly into assets. Look, force even just $50 a month into a Roth IRA so compound growth starts working for you, not against you. And finally, use the tax system strategically. Maximize those 401ks, HSAs, and FSAs to capture what is essentially free money and tax savings.
At the end of the day, the divergence we're seeing is real, it's structural, and it is growing. The stock market being at a record high is not a sign that everyone is doing well. It's simply a sign that stock owners are doing well. The ownership gap is the defining financial challenge of our era. So, knowing exactly how the mechanical forces of this K-shaped economy work, where are you going to position yourself?
And on a very special final note, this actually marks our 50th Explainer milestone. I just want to take a quick moment to sincerely thank all of you focused learners for being part of this journey. Whether you've been here since Explainer number 1 or you just stumbled across us today, thank you so much. We are totally dedicated to breaking down these complex topics for you. Please remember to hit that like button, share this with someone who needs to see it, and subscribe so you never miss one of our structured deep dives. And I genuinely want to know, drop a comment below right now, which explainer has been the absolute most useful to you so far. It directly shapes what we cover next. Keep learning, keep focusing, and I will see you in the next one.